Hey guys, traders usually combine multiple time frames to get more accurate analysis and better entry points. But when you apply every trading concept from the monthly chart down to the lowest time frames, your chart can end up looking like this: messy, confusing, and not useful at all. So, is there a way to use multiple time frames while keeping your analysis simple, clear, and actually helpful? Yes, absolutely. And that's exactly what this video is about. Today, we'll explain what top-down analysis is, why it matters, and show you our method for doing it the right way. By the end of this video, you'll know exactly which time frames to combine and how to apply price action and smart money concepts on each one. Thank you for hitting the like button and for sharing your thoughts in the comments. So what is top-down analysis? It simply means starting your chart analysis from higher time frames, like weekly and daily, and then working your way down to smaller ones, such as the 4-hour, 1 hour, and 15-minute to get more precision. Why is top-down analysis so important? Because it helps you understand overall market conditions before taking any trade. Higher time frames reveal the main trend and major structure levels. Once you move down to lower time frames, you can find much cleaner entries and avoid setups that go against the bigger picture. In short, it keeps you aligned with the market direction, reduces unnecessary losses, and boosts your confidence. Here's an example. On the 15-minute chart, we can see a clear downtrend. Entering short on a pullback may seem like a good idea, but once we check the 4-hour chart, we notice the price has reached a key structure level. This increases the chance of a reaction, which makes that short entry less reliable. Another example, on the 1-hour chart, we have an uptrend. When we switch to the daily chart, we can see that the next major level is still far away, giving the price room to move. So when we return to the 1-hour chart, we can take a long setup comfortably and aim for the daily structure. In a third example, price is stuck in a 5-minute consolidation. A break either way could create a move, but the 1-hour chart shows that the overall trend is bullish. That means we should focus only on buys. A break below the range is more likely to be a failed breakout, and once price returns back inside, we can look for long entries aligned with the higher time frame. In another example, price pulls back into a supply zone, but we're unsure if it will reject. Here, checking a lower time frame can add confirmation. A break of a trend line or a change of character gives a strong reversal signal. After that, we can identify fresh supply zones on the lower time frame and enter with better accuracy. All these examples show how combining multiple time frames helps you get clearer analysis and more precise entries. But the benefits of multi-time frame trading go further. However, this does not mean starting from very high charts like the monthly and applying every concept you know. Keeping things simple is crucial to avoid confusion and stay consistent. So let's continue with the smart risk top-down analysis technique. This approach begins from the weekly and daily charts. The main analysis happens on the 4-hour and 1-hour charts. For extra confirmation, you can zoom into the 15-minute and 5-minute charts, but that step is optional. When you combine price action with smart money concepts, the goal is to find the true market direction, identify key levels, spot high-quality zones, and take clean trades. Now let's apply this step by step. Step 1. Start with the weekly chart. On this chart, all we do is mark key market structure levels, nothing more. We don't apply other concepts here because they're unnecessary at this stage. Our main trading happens on the 1-hour and lower. These levels matter because when price touches them, we expect a strong reaction. What are market structure levels? They're areas where price has shown significant reactions before. But 5 factors make a level stronger, acted as both support and resistance. Levels that serve both roles have a higher probability of holding again. Strong move away. If price previously left the area aggressively, it means the level is meaningful. Multiple rejections. More reactions equals stronger level, though not guaranteed until a break and retest. Turning points. Areas where price reversed direction strongly tend to attract reactions again. Recently respected. Fresh levels are generally more powerful than older ones. Now let's mark the levels on the weekly USD chart. We only draw levels near the current price to keep things clean. Always place them where you capture the most touches. Treat levels as zones, not exact lines. We mark the major resistance above, the key mid-zone acting as support and resistance, and the long wick area below. That's all we need from the weekly time frame. Next, we move to the daily chart. Here we adjust the weekly levels if needed, and then add the daily structure levels in a different color. This helps us distinguish them later, since higher time frame levels are more important. We mark the daily level above price, which recently acted as both support and resistance with a strong reaction, and we also mark the lower turning point. That's everything needed from the daily chart. No extra concepts yet. Now we move to the 4-hour chart. This is where we begin applying smart money concepts: market direction, imbalance, supply and demand, liquidity. Let's quickly define these. 1. Market direction. A trend forms when price creates a 1-2-3 move and breaks structure. As long as price stays above the protected swing low, the trend is bullish. A break below that low creates a change of character, signaling a possible reversal. 2. Supply and demand zones. These are areas where large orders previously entered the market. A strong zone has an imbalance, fair value gap, a break of structure, and a strong push away. An example of a high-quality demand zone is when all three conditions are met. Third, liquidity. Liquidity is found below swing lows and above swing highs. When liquidity forms above a demand zone, the zone becomes more reliable because price often grabs liquidity before making a strong move. A valid liquidity grab breaks the area, triggers stops, then immediately returns. Now let's go back to the 4-hour USD example. The 4-hour chart shows a clear uptrend, but price has tapped a higher time frame key level, which may slow or reverse the trend. Just below the current price, we have a strong demand zone that aligns with a weekly level. If price reaches it, we expect a strong reaction. To trade this, we'll check the 15-minute chart later for confirmation. Next, we move to the 1-hour chart, our main trading time frame. Here, structure is unclear because price formed a change of character by breaking a key level. This hints at a possible reversal, but the 4-hour chart is still bullish and we have a strong demand zone below, so the best move is to wait for clarity. If price breaks below the 4-hour zone, supply takes control, and both the 1-hour and 4-hour charts turn bearish, giving us clean short setups. If price rejects the 4-hour demand and breaks above the daily level, both charts become bullish and we look for longs. Let's play the chart forward. Price eventually breaks below the demand zone. Now supply controls the market and both structures are bearish. This gives us a short setup. We mark the breakouts, the supply zones, and the equal highs acting as liquidity. If price pulls back into the supply area, that becomes our entry. We get another breakout and another supply zone forms, letting us continue shorting until price reaches the next major level. And that's the full breakdown for today. I hope this helped you understand how to combine smart money concepts with multi-time frame analysis. If you enjoyed the video, don't forget to like and subscribe, and I'll see you in the next one. If you want to stay updated,